I'm Daniel Levine, and this is the Bio Report. Last year, the biotechnology industry set records across the board for financial metrics, a reflection of product successes, new drug approvals, and free-flowing investment capital. Despite the record performance, concerns continue about growing pricing pressure and maturing pipelines that represent challenges with which the industry must contend. We spoke to Glen Giovannetti, EY's global life sciences leader, about his firm's recently released Beyond Borders report, what the numbers tell us, and what the industry will need to do to keep the good times rolling. Glenn, thanks for joining us.
Hey, it's great to be here, Danny. Thanks for having me.
EY released its annual Beyond Borders report at the annual Bio International Convention that recently concluded. By almost any measure, last year was a stellar year. How good a year was it in terms of the numbers?
Well, you got it right. It was a stellar year, really off the charts. In fact, we titled the report Reaching New Heights for just that reason. But on almost every key metric, the industry either set a record or, set a 10-year high. So we're talking about revenue, profitability, IPOs, capital raised, market cap. So yeah, a very strong year across many measures, and much of the reason that people are feeling pretty confident these days about biotech.
Gilead Sciences enjoyed unprecedented success with its hepatitis C franchise, so much so that throughout the report you qualify the numbers. Even without Gilead, it was a big year, but how big an impact did Gilead have on the overall numbers?
Well, I guess you'd have to think about that in a couple of ways. So one of the things we've done for a number of years in the report is to separate out what we call the commercial leaders, which are companies with more than $500 million of revenue, from the rest of the industry, the great preponderance of which is earlier stage R&D companies, most that don't have a product on the market. But certainly within the commercial leading group of companies, Gilead's launch of their hepatitis C franchise, was unprecedented and had a huge impact on revenue, on profitability, on almost all the financial performance measures. But, I didn't see it so much as qualifying that we were saying how the industry do without Gilead, but really to point out that, Gilead's results were phenomenal, but the rest of the industry still performed pretty darn well. So the other commercial leaders still saw their top line grow double digit, about 12%. They actually increased their R&D spending by 14%. And that group of companies actually saw their market cap grow by 40%. So, Gilead was certainly a bellwether and certainly brought enthusiasm to the sector, from an investor standpoint. But, the rest of the commercial leaders performed very well. And in fact, of course, it was a great year for the smaller companies as well, especially on the capital raising side.
As you just mentioned, there's been a healthy increase in R&D spending. Put it into perspective for us. What significance do you see in this?
Well, I think it's really it's a question of confidence. Obviously, R&D investment, well spent. And I think I'd argue that most of the smaller companies are very focused and, pretty efficient in their use of capital. So, more capital available, well spent, should drive, more prolific pipelines downstream. So that's good. But I think it's worth taking a step back to remembering the period right after the financial crisis where the confidence just wasn't there that the capital would be available as companies needed it. And we saw a lot of companies pull back, appropriately so. They really didn't have an alternative, but pull back to really funding their lead asset and frankly putting some of the rest of the pipeline, on ice for a while, if you will. And, that has the effect of course, magnifying the impact of that lead product and sort of putting all eggs in one basket. So I look at, the situation today where in the last 2 years, really, where capital flows have been, very significant in the industry, is providing companies with a greater degree of optionality. We know that most things in biotech don't pan out. Most drugs don't make it all the way through, and so having optionality to be placing bets across the pipeline to be gaining interest from pharmaceutical partners potentially across the pipeline, really speaks well to the strength of the industry.
The IPO market continues to drive on. What do valuations say about investor appetite, and are we seeing spillover to other markets beyond the United States?
It's been a phenomenal, U.S. primarily driven IPO market. As you know, 2013 was strong. To confess, I didn't foresee that 14 would be the year it was. We'd never seen, going back in the 30 years, that we've been tracking the industry, an IPO window that lasted beyond 4 or 5 quarters, and we're arguably in our 9th quarter now of a pretty, still pretty open window. People might argue that it was getting a little more challenging in this most recent quarter, but we've just seen, a half a dozen or so deals close. So I'd argue it's still open. That's, again, phenomenal in terms of the access to capital and what that means for those companies who are able to access that market. It's certainly been fueled by enthusiasm from generalist investors who have, really, not only rotated in heavily into the sector in 13 and 14, but have, stayed in and are still backing some of these IPOs today. In terms of spillover, 13 was not a strong year from an IPO perspective in Europe, but 14 rebounded to be, the second best year ever for IPOs in Europe. Second only to the year 2000, which was, of course, the genome bubble era, and really the amounts of money raised in Europe that year may never be approached again. But this was the first time we've really seen the market open in quite some time in Europe. This is after 6-7 years of almost no activity. So I think there was a value arbitrage play there, where some later stage companies, as investors looked at the valuations that were being obtained in the U.S. These assets looked interesting, and therefore there was enthusiasm when they came public. I would note that about a dozen of those companies, I think there were 31 that went public in 2014, and in Europe, about a dozen of them chose to list in the United States on NASDAQ.
The robust IPO market means venture investors have been getting exits. There's been a dramatic change from time of first investment to IPO. Can you put that in some perspective, and what's the impact been on new venture investment?
Well, that's an interesting phenomenon, because a few years ago we charted that, and you're absolutely right that the period from founding to exit, either through an IPO or M&A transaction, had gone up to 8 or 9 years, which is a real challenging length of time, from a rate of return perspective for investors, for venture investors, but also, because most often their funds have 10-year lives. So, an exit that takes that long can be a real challenge from a fund management standpoint. Some of that, frankly, is reversed with this IPO market. We saw a number of deals where companies got out very early. I'd say the first wave of companies may have been a little more mature, because we haven't seen a robust market prior to 2013. But as you looked at the progression of companies across the latter parts of 13 or 14, we saw many companies that have really gone from founding, less than 5 years ago to IPO, which, is something we hadn't seen for many, many years.
M&A activity was strong, particularly if you factor out mega transactions. What are valuations saying, and how much competition was there between big pharma and big biotech?
Yeah, well, valuations are saying, and I'd say this is both in the M&A and in the alliance space, that it's a good time to be a seller in biotech. It's a seller's market because companies have options. There's plenty of capital, at least for the time being, available from the equity markets, and so biotechs are negotiating from a position of strength. So we certainly saw exit premiums, M&A premiums go up this past year. I know we analyzed it for the top 10 deals, and the premium went up about 9% to 45%, so pretty healthy premium over the so-called undisturbed stock price. So yes, there is negotiating power amongst amongst biotechs. On the flip of that, pharma in particular is still looking for attractive assets to acquire. They have their own growth challenges. In the past year, pharma has been more focused in a way on transactions around their own portfolio. We saw a lot of sort of trading of businesses or therapeutic franchises among pharma companies as they sought to gain greater focus in their business. But for those that were sellers, they freed up a lot of capital, and our expectation was they'll continue to look for attractive biotech assets to drive their own future growth. Big biotech hasn't been a big player in the past couple of years in M&A. They've had such healthy growth. I don't think the need to do anything significant was there. They are going to be coming up periods where showing comparable growth as compared to a very strong 2014 and 2013 may become more challenging. I suspect we may see them step in, especially since they have an awful lot of dry powder. They've both in terms of profits and their market valuation. So again, I think good time to be a seller. Pharma looking for assets. Big biotech's got a lot of firepower to do deals. There's specialty pharma companies that have been active and also looking to do deals. So we expect those premiums to stay robust.
It was a busy year for partnering deals as well. I think you'd characterize that as a seller's market too. What impact did that have on upfronts and total deal values?
Total deal values, as you know, in this industry, Danny, are measured in biobucks, which are maybe worth looking at just in terms of the richness of deals. We know all that cash won't change hands, but the biobuck value of deals did soar amongst U.S. and European biotech companies to over $50 billion after 3 years where it had been down under $30 billion. We'd really seen sort of a step down in the potential value of deals. So again, indicative of a seller's market. But as you note, we would think the bellwether of the actual upfront payments is more important to watch. And that number soared as well this last year to just over $5 billion. So you can think about the many billions raised in the capital markets, but an additional $5 billion coming in upfront from big pharma, and in this case, big biotech, certainly adds to the strength of these balance sheets. And again, that was a significant step up over each of the last 3 years.
Well, biotech is a maturing industry. Are we heading towards a situation where the largest biotechs are going to face the type of problems that big pharma faced in terms of filling their pipeline to fuel growth, as well as facing competition from biosimilars and creating a patent cliff of sort for this industry?
I think the long-term answer to that is yes. I mean, that's the evolution of the industry, that, companies are pressured to come out with innovative new products, and that innovation has to be increasingly at the science level, but also at really at the health system level. And by that, I mean demonstrating, true value to patients in terms of improved outcomes or significant efficiency to the health system in terms of cost savings, and, possibly, preferably both. So that's the reality of everybody operating in the drug business. Biosimilars have been a long time coming. They're basically here today, and you see a lot of significant companies jumping into that area, seeing it as a significant market opportunity. I do expect we'll see increasing amounts as both regulators get more comfortable with biosimilars and payers, desire more competition. We'll see that as an inevitable evolution of the competitive landscape for the mature biotechs. They remain focused on and are producing very significant new medicine. So, it's a reality of the life cycle of the industry. I don't think it is a negative. I think there's still some fantastic innovation happening amongst the big biotech companies that make their future growth prospects continue to look strong.
When this industry worries about threats and challenges, pricing seems to come to the top of the list these days. We saw PBMs try to bring competition to bear to drive pricing down. Cancer Docs recently launched an online cost comparison tool. Are any efforts bringing about meaningful change, and how big a threat is pricing to the industry?
Well, I put this all in the category of evolution, more focus on value. for price. I mean, the headlines are price, but the real conversations around value. Did patients benefit, or did the health system overall benefit? That is a reality. We can call it a threat, but it's the reality. You're not going to be able to produce a product that's in a heavily competitive area and market it intensely and get the same results you might have, 5 or 10 years ago. This is really going to be a question of data, often real world data about demonstrating real benefits. So I think that's been internalized by most companies in the industry, big pharma, big biotech, even those, thinking about their R&D pipelines. How that's going to manifest itself in terms of innovative pricing or at-risk pricing or other models is something we're beginning to study very carefully. I mean, there's some, early experiments in that area, but it's really too early to tell how that's going to play out. But yeah, this is the reality of the industry. It's going to require more differentiation and more data to prove that differentiation really has value to payers and to patients.
Are there other things the industry should be worrying about? What do you think will bring an end to the good times?
Well, again, I think I separate that from the largest companies who have plenty of capital to fund their business and to either bolster their internal pipelines or go out and acquire interesting technologies. They're really playing from a position of strength, and so the real question here is just what we covered. It's making a compelling case both for their existing products and what's in the pipeline around pricing and value. For the rest of the industry, the earlier stage companies, their fortunes are tied closely to the capital markets and to the availability of capital. And, the questions come up a lot, is this a bubble? And, certainly you can look at metrics where there are values of earlier stage companies that look frothy. The question for me is one of, is it a case of a bubble that pops suddenly and investors feel burned and retreat all at once? Or is it a question more of this being a generalist-led rally? And as generalists will do, they may rotate to other sectors that look relatively inexpensive by comparison, and such that we might see the air come out of the balloon, if you will, in a little more orderly fashion, kind of a hard landing versus soft landing. I don't know the outcome to that, but I do think that there's enough excitement and there's enough real science and enough pipeline potential in these earlier stage companies that I don't think it's going to be a case of a single product failure of an early stage company spooking the entire market. So, we won't divorce the fact that the early stage companies are tied to the fortunes of the capital market, but I'm hopeful we'll have a period here where even as we come off the top, there'll be, relative decent access to capital for all these newly public companies.
Glen Giovannetti, EY's Global Life Sciences Leader. Glen, thanks so much for your time.
Hey, Danny, thank you. Appreciate it being here.
Thanks for listening. The Bio Report is a production of the Levine Media Group. To automatically download this podcast each week, subscribe to our RSS feed or through iTunes or other podcast manager. To join our mailing list, go to levinemediagroup.com. We'd love to hear from you. If you want to drop us a line or are interested in sponsoring this podcast, send email to danny@levinemediagroup.com. Special thanks to Jonah Levine, who composed our theme music, and the Jonah Levine Collective, which performs it.